Hello, this is Dan Passarelli with Market Taker Mentoring. Today, I want to visit an all-important topic for all option traders, and that is how to analyze volatility. Now, there's a lot of talk out there these days about trading volatility. The CBOE has some fantastic products in the VIX family, which are all volatility products, and traders can go out there and trade pure volatility. But what about traders who aren't trading the VIX or assets in the VIX family? What if you just simply are an income trader? You trade credit spreads. You trade, iron condors. You trade time spreads. Or maybe you're just a simple directional trader. You buy calls, you buy puts. You're still trading volatility with these, whether you know it or not, whether you want to or not, you are. Because every single option trade has a volatility component to it. Vega measures implied volatility risk. That's one of the Greeks. That's part of every single option trade. So, all traders must understand how to analyze volatility. So I'm going to give you a crash course right now. There are three things a trader must do in order to analyze volatility on every single option trade. First, the trader needs to look at the implied volatility chart over a 6-month period. If the trader is considering taking a long position, a trader would want to see the implied volatility in the lower half of its 6-month range. Now, when I say a long position, I mean a long position in volatility, buying options, whether bullish or bearish, whether calls or puts. If a trader's buying options and thus getting long Vega, that implied volatility needs to be in the lower half of its 6-month range. If the trader's selling options, taking a bullish position, a bearish position, any way that a trader is net selling and collecting option premium, the implied volatility needs to be in the top half of its 6-month range. The second thing, traders need to compare current implied volatility to current historical volatility. Traders buying options want to see implied volatility below historical. Traders selling options want to see implied volatility above historical. When the implied volatility is below historical, it means options are cheap. When implied volatility is above historical, it means they're expensive. Now, traders need to do those two things, but they need to do one more thing as well. Because what happens going forward is what really determines whether or not one makes money or loses money on a trade. Traders need to consider the future of implied volatility and the future of historical volatility. They need to consider, okay, maybe right now implied volatility is high, making that a good setup for an income trade. But is there a good chance that historical volatility is going to rise tomorrow? That the underlying stock is going to get more volatile? For example, if I were thinking about trading an iron condor, I would look for implied volatility. Implied volatility should be in the top half of the 6-month range. I would look for implied volatility to be above historical. But I need to consider what is the chances of there being increased volatility in that underlying stock. Because if there is, I can lose money on that iron condor. If the stock breaks out of the range, I can look at it, just a simple P&L chart, and observe that, yeah, that's a bad thing. Too much volatility is bad. But looking at a volatility chart, if I see the historical volatility later, after I made the trade, rise above implied, well, that's just as bad an indication. That means the underlying stock moves too much and I'm in trouble. So traders always need to consider those three things: implied volatility charts, implied versus historical, and what the future may hold for volatility in the asset they're thinking about trading. This is Dan Passarelli with MarketTaker.com.